Over $40 trillion is sitting inside retirement funds right now. Most people believe it's safe, but most of it isn't protected. It's invested. And it can't simply be paused or reversed when conditions change. Retirement systems don't break because people panic. They break because timing removes choice. And this is where it becomes personal. You did everything they told you to do. You worked for decades. You showed up every morning. You saved consistently, month after month, year after year. You didn't gamble. You didn't chase shortcuts. You trusted the system. And now, at the exact moment when you're supposed to feel secure, something doesn't feel right. You look at your retirement account and you see a number. But what you really feel is uncertainty. Not because you don't have money, but because you don't know how fragile that money actually is. No one told you that your retirement would still depend on markets behaving well. No one told you that volatility late in life is different from volatility early on. No one told you that the rules quietly changed while you were busy building your life. And the most frustrating part? You did nothing wrong. The risk you're carrying isn't the result of bad decisions. It's the result of a system that transferred risk onto you without ever asking your permission. That's what this video is about. Not fear, not panic, but understanding a risk that millions of Americans only discover when it's already too late. If you're in your 20s or 30s right now, you probably think the next financial crisis will hit the usual suspects. The crypto gamblers throwing money at meme coins, the day traders leveraging themselves to the hilt, the speculators chasing the latest get-rich-quick scheme. But here's what might shock you. The group facing the biggest financial risk in America today is not the risk takers. It's the people who did everything exactly right. They worked steady jobs for decades. They contributed to their retirement accounts every month without fail. They followed every piece of conventional wisdom about saving and investing. They stayed disciplined when markets were volatile. They built their nest eggs slowly, methodically, the way the system told them to. Today, a massive portion of that lifetime of careful work sits inside portfolios that are far more fragile than most people realize, not because retirement planning is fundamentally flawed, but because the entire American retirement system isn't actually designed the way most people think it is. Here's the truth that changes everything. What we call the American retirement system is not really a retirement system in the traditional sense. It's a market participation system. And that single distinction explains why millions of Americans who thought they were building security have actually been building exposure. Think about how your grandparents might have retired. Many of them had pensions. The company promised them a specific monthly payment for life, and the company took on the investment risk. If the markets crashed, that was the company's problem, not theirs. But over the past few decades, we shifted to a completely different model. Now, instead of promised benefits, we have contribution accounts. Your 401k, your IRA, your retirement savings are all tied directly to market performance. When markets go up, you benefit. But when they go down, you absorb the full impact. Now, this isn't necessarily bad, but it creates a timing problem that most people don't understand until it's too late. When you're 25 and the market crashes, that's actually an opportunity. You can keep contributing at lower prices. You have decades to recover. Time is your ally. And this is the moment where a lifetime of discipline can quietly unravel in just a few years. But when you're 62 and the market crashes, time becomes your enemy. You might have planned to retire at 65, but suddenly that timeline is in question. You might have planned to help your children buy homes or support your grandchildren's education, but now those plans feel uncertain. Most importantly, you can't just wait for the long-term average to play out, because you need income now. Imagine being 67, watching your portfolio fall, knowing that every withdrawal now locks in losses, and realizing there is no reset button anymore. This is what most financial commentary completely misses. People talk about market returns like they're just numbers on a screen, but retirement returns aren't numbers. They're years of your life. They determine whether you retire with dignity or work until you physically can't. They determine whether you're financially independent or become a burden on your family. At that point, market returns stop being percentages. They become years of your life. And here's where this gets really uncomfortable. The current environment makes this timing risk more dangerous than it has been in decades. To understand why, you need to see the scale of what we're talking about. As of the end of 2025, Americans have about $48 trillion sitting in retirement accounts. That's not a typo. 48 trillion with a T. To put that in perspective, that's roughly 1.5 times the size of the entire U.S. economy's annual output. This isn't some side pocket of American wealth. Retirement assets represent about 1/3 of all household financial assets in the country. When we talk about retirement risk, we're talking about the financial foundation of American society. Now, here's where demographics make this a ticking time bomb. The baby boomer generation, roughly 70 million Americans born between 1946 and 1964, represents the largest generation in American history, and they're all approaching or already in retirement right now. This matters because baby boomers hold a disproportionate share of retirement assets. simply because they've had more years to contribute and more time for compound growth to work. But here's the catch. Unlike younger generations, they don't have time to recover if markets go through an extended rough patch. When you're 30 and your portfolio drops 20%, that's psychologically uncomfortable, but you can recover. When you're 67 and drawing income from your portfolio, a 20% drop isn't just a paper loss. It's a permanent reduction in your retirement security because you're forced to sell shares to pay for living expenses. This is called sequence of returns risk, and it's the most underestimated danger in retirement planning. Two people can have identical portfolios and identical average returns over 30 years, but if one person experiences major losses early in retirement while the other experiences those same losses later, their outcomes can be completely different. The person who gets hit early might run out of money, even though their average returns were exactly the same. Now let's talk about what these retirement portfolios actually contain, because this is where the myth of automatic safety falls apart. When most people hear that their retirement fund is diversified, they imagine something robust and carefully engineered. In reality, most retirement portfolios are diversified only within a very narrow framework. They typically hold a mix of stock funds and bond funds based on the assumption that stocks provide growth while bonds provide stability. That assumption worked reasonably well for decades, especially during the long period when interest rates were falling. When rates fall, bond prices rise, often providing a cushion when stock prices fall. This negative correlation created the appearance of true diversification. But correlation isn't a law of nature, it's a regime effect. And regimes change. In the current environment, with higher inflation pressures and central banks raising interest rates, bonds can fall at the same time as stocks. What looked like diversification on paper can suddenly become concentrated exposure to the same macro forces. Many target date funds, which are the default option in most 401k plans, still hold 50 to 60% stocks, even for people close to retirement. The bond portion often includes long-duration government bonds and corporate bonds, both of which are highly sensitive to interest rate changes. So when someone says their 401k is diversified, what they often mean is, I own stocks and bonds. But that's not diversification in the way most people emotionally understand it. That's two asset classes that can both be hurt by the same economic conditions. This is where the illusion of safety finally breaks. This brings us to why the current cycle is different from what retirement savers experienced over the past several decades. For the last 15 years, retirement portfolios operated in an environment defined by three key factors: falling interest rates, abundant liquidity, and aggressive central bank intervention whenever markets got stressed. The combination created a powerful tailwind for traditional retirement portfolios. Falling rates meant bond prices generally rose. Abundant liquidity meant asset prices were supported even during temporary stress. And central bank intervention created an implicit safety net that made risk-taking feel safer. But that environment is ending. Interest rates are higher than they've been in years. Government debt levels are at historical extremes, limiting fiscal flexibility. Inflation is a real constraint on policy options, and central banks can no longer provide unlimited support without consequences. This doesn't guarantee a market crash, but it does change the risk profile for retirement portfolios in ways most people don't understand. Higher interest rates mean bonds behave differently. When rates are rising, bond prices fall, potentially at the same time as stock prices. High debt levels mean governments have less room to respond to crises with massive fiscal stimulus. Constrained central bank policy means the automatic backstop that supported markets for years may not be as reliable. For retirement funds, this combination is particularly dangerous, not because markets will necessarily collapse, but because the margin for error is much smaller. In a forgiving environment where central banks quickly cut rates and flood the system with liquidity, portfolio mistakes get masked. Recovery happens relatively quickly. But in a constrained environment, mistakes compound. And unlike institutional investors or speculators, retirees can't simply wait indefinitely for recovery. This is where forced selling becomes the hidden killer of retirement portfolios. Most people imagine that investment losses happen because investors panic and sell at the wrong time. But retirees don't sell because they're emotional. They sell because they have to, not because advisors are malicious, not because markets are rigged, but because once this risk is transferred to you, no one is responsible for the outcome anymore. This isn't a failure of discipline. It's a failure of assumptions. If you're no longer earning a salary, your portfolio becomes your paycheck. Rent, utilities, food, healthcare, insurance, none of these expenses wait for markets to recover. So when markets fall, withdrawals continue, creating a brutal asymmetry. When markets are rising, withdrawals feel harmless. You're taking money out of a growing pot. When markets are falling, withdrawals become destructive. You're forced to sell more shares to generate the same dollar amount, permanently reducing your portfolio's ability to participate in any future recovery. This isn't a temporary setback. It's permanent capital destruction. And it happens regardless of how the markets perform over the long term. Now, zoom out and consider what happens when this dynamic plays out across millions of portfolios simultaneously. When a large generation is drawing down retirement assets at the same time, that creates structural selling pressure that doesn't depend on fear or speculation. It depends on cash flow needs that can't be postponed. This forced selling interacts with other forms of market stress. When asset prices fall, margin calls force leveraged investors to sell. Mutual funds facing redemptions sell to meet withdrawal requests. Pension funds rebalance mechanically, and retirees continue their monthly withdrawals. Each of these alone can be absorbed by markets. Together, they create feedback loops that can turn ordinary market volatility into prolonged downturns. This is how retirement stress becomes more than just a personal finance issue. It becomes a social and economic problem. Retirees aren't just investors, they're consumers, parents and grandparents who support families and communities. When retirement portfolios are under pressure, spending behavior changes, discretionary purchases get delayed, major expenses get avoided, healthcare decisions get influenced by financial constraints. This matters because consumer spending drives a significant portion of the U.S. economy. A broad-based pullback in retiree spending doesn't show up as dramatic headlines, but it shows up as weaker growth, slower hiring, and fragile confidence throughout the economy. The effects cascade further. If retirees delay retirement because their portfolios are weaker, younger workers face career bottlenecks. If retirees need to rely more heavily on family support, it shifts financial pressure to younger generations already dealing with their own economic challenges. There's also a political dimension. A large, economically stressed retiree population changes voting behavior and policy priorities. It increases pressure for government intervention, which often involves fiscal expansion, monetary accommodation, or regulatory changes that can introduce new risks into the financial system. This is why retirement risk can't be treated as an isolated issue. It connects markets, demographics, politics, and social stability in ways that make it much bigger than individual portfolio management. So why don't more people see this coming? The most dangerous risks aren't the ones people fear. They're the ones people assume are being handled by someone else. Retirement risk falls squarely into this category. Most Americans believe their retirement savings are professionally managed, which creates a false sense of security. This isn't because financial advisors are incompetent, but because the system itself encourages passive trust. There are several psychological forces at work here. First, authority bias. People assume that if a retirement plan is offered by an employer, regulated by law and managed by professionals, it must be safe. That assumption discourages deeper questioning. Second, recency bias. For most of the last 15 years, markets recovered relatively quickly from major shocks. That experience conditions people to believe recovery is inevitable and timely. But recency bias is dangerous because it assumes the most recent environment will continue indefinitely. Third, complexity avoidance. Retirement systems are intentionally complex, with multiple account types, tax rules, and investment options. Most people don't have the time or desire to understand all the details, so they simplify the system down to a comfortable label like my 401k. Finally, there's emotional avoidance. Confronting retirement risk is deeply uncomfortable because it forces people to question plans they have relied on for decades. It challenges fundamental assumptions about security and control that most people would rather not examine. This combination creates a dangerous environment where risk is hidden not because it's secret, but because it's inconvenient to acknowledge. The system functions smoothly as long as markets behave within expected ranges, but when they don't, the fragility gets exposed suddenly, and by then, options are limited. This is why this conversation matters now, before a crisis, not after. Not to create panics, but to replace false confidence with informed awareness. At this point, it should be clear that we're not talking about a typical market problem. We're not trying to predict the next crash or time market tops and bottoms. We're not blaming individuals for making bad decisions. We're talking about a fundamental mismatch between how the retirement system is structured and the environment it now operates in. For decades, Americans were taught a simple story. Work hard, save consistently, invest in diversified portfolios, and let compound growth do its job. For a long time, that approach worked reasonably well, but systems don't fail because they were wrong initially. They fail because conditions change while assumptions don't get updated. The current retirement system assumes that long-term averages matter more than sequences and timing. It assumes diversification works the same way in all market regimes. It assumes liquidity is always available when you need it. It assumes time is always your ally. Those assumptions aren't universally true. They're dependent on specific conditions. And when those conditions change, risk doesn't disappear. It relocates to the people least able to absorb it. Near retirees, current retirees, and the families who depend on them. This is the uncomfortable truth that most financial commentary avoids because it does not fit neatly into bullish or bearish narratives. Markets don't need to collapse for retirement outcomes to deteriorate. They only need to underperform expectations for long enough. Slow erosion can be just as destructive as sudden collapse, especially when portfolios are tied to ongoing withdrawals that can't be postponed. If you're approaching retirement or already retired, the most important shift in thinking is this: you're no longer just an investor trying to beat the market. You are a liability manager trying to fund a life under uncertainty with limited time to recover from mistakes. And the hardest part? Most people will only realize this after the system has already forced their hand. This is the part most people miss. Retirement risk isn't T about markets failing. It's S about timing taking control away from you. That requires asking different questions. Not what has the highest expected return, but what allows me to avoid being forced to sell at exactly the wrong time. Not what worked over the past 30 years, but what works when liquidity is constrained and volatility persists. Not what does my statement show, but what happens if this challenging environment lasts longer than expected. These are uncomfortable questions, but they're the right ones for the current environment. For younger viewers, this matters too, because what happens to retirement funds doesn't stay isolated within those accounts. It affects consumption patterns, housing markets, family dynamics, political pressures, and fiscal and monetary policy decisions. When a large share of the population feels financially insecure, the entire economic system reacts. Understanding retirement risk isn't just about personal financial planning. It's about understanding one of the major forces that will shape the economy and society over the next decade. The critical distinction I want to leave you with is this: acknowledging risk does not mean abandoning markets, going to cash, or assuming the worst. It means recognizing that growth and preservation aren't the same objective, even though most retirement strategies treat them as if they are. Most retirement approaches assume you can optimize for growth and get preservation as a side effect. That assumption worked during a very specific historical window when rates were falling, liquidity was abundant, and central banks provided consistent support. It may not work as well in the next phase. Retirement planning isn't about maximizing returns. It's about minimizing regret. Regret from taking risks you didn't understand. Regret from selling at the wrong time. Regret from discovering vulnerabilities when you no longer had the flexibility to adapt. Avoiding that regret doesn't require predicting the future. It requires preparing for multiple possible futures. And that preparation starts with awareness. Awareness of what you actually own, why it behaves the way it does, and when it might fail you, not just in theory, but in practice. The goal isn't to predict the next crisis. The goal is to make sure that when stress arrives, whether fast or slow, you're not forced into irreversible decisions. Retirement security isn't guaranteed by labels or professional management or regulatory oversight. It's earned through careful alignment between your strategy and the reality of the environment you're operating in. And that alignment is something every individual needs to revisit as conditions change. This conversation isn't about fear. It's about replacing comfortable assumptions with clear-eyed preparation. Because in retirement planning, the cost of being wrong isn't just a bad year in your portfolio. It's potentially decades of reduced security and independence. The retirement funds are under massive risk, not because markets are about to crash, but because the entire system is built on assumptions about time, liquidity, and correlation that may no longer hold. Understanding that risk is the first step toward managing it intelligently.